I'm Chris Wilson. Um, Hi, everyone. I'm Chris Wilson, Vice President of Programs for the Society, and welcome to our online series, Crypto 101, Intro to Bitcoin, Blockchain, and Crypto. And special thanks to our webinar sponsor today, Bitwise Asset Management. Before we get into today's content, just a few reminders. Upcoming events include our annual meeting that will also cover a fireside chat with Tony Ressler. That's on June 15th from 5:30 to 8 p.m. And that's going to be at the Buckhead Club. We also have an annual volunteer appreciation event at Topgolf Atlanta Midtown on August 11th, again from 5:30 to 8 p.m. And then further out, we're going to be hosting a session on the outlook for the natural gas industry. And that will also be at the Buckhead on August 31st from 12 to 1 p.m. As always, check out our website for more details, as well as the opportunity to register for these events. And we would strongly encourage you to register for the annual meeting as soon as possible, as space will be limited, and we're expecting this is going to be a pretty popular event. Lastly, in your email boxes associated with your local membership, you're going to get two important emails. One is the proxy for voting for this year's trustees for our board. Please take a minute to go ahead and cast your ballot for that. CFA Institute has also been sending out a proxy regarding bylaw changes. And then lastly, we have our membership survey. The only way that we can deliver the best service for you is if we get your feedback. Thanks again for that. Now, as I mentioned, so we're joined today by Sophie Mullin. She is a business development officer at Bitwise Asset Management. As with all of our webinars, please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, let me hand things over to Sophie.
Thank you, Chris, and thank you everyone for joining today. Excited to spend some time with you all this afternoon. As Chris mentioned, I am the Southeast Business Development Officer for Bitwise, and today we're going to walk through what we at Bitwise call our Crypto 101, where we'll walk through building the foundation of Bitcoin, blockchain, and crypto, explaining what is Bitcoin, what is blockchain, what is crypto, and why are they so important. So bear with me one moment as I share my screen here. Perfect. So in terms of an agenda today, we'll walk through who is Bitwise, what is crypto, and why is it so important, why more than one crypto asset exists, and then where crypto fits from a portfolio construction standpoint. So to start, who is Bitwise? Bitwise is a specialty crypto asset manager that was founded in 2017. We're best known for creating the world's first and largest crypto index fund, BITW, as well as for creating the world's first ETF to be able to include the word crypto in its name, our crypto equities ETF, BITQ. Today, we manage over $1 billion in assets across our fund family of 12 strategies that provide access to direct crypto assets, to crypto equities, as well as to more niche spaces of crypto like decentralized finance and NFTs. We're well known in the space as a thought leader, known for our research briefs, white papers, and advisor letters. Our CIO, Matt Hogan, the former CEO of ETF.com, and our head of research, David Lawant, were actually tapped on the shoulder by the CFA Institute to co-author their guide to Bitcoin, blockchain, and crypto. And to this day, it's the CFA Institute's most downloaded research brief ever. Ultimately, here at Bitwise, our goal is to provide advisors and financial professionals with the insight and information they need to answer questions about the space as they come up. And so with that, we'll go ahead and dive into the meat of the presentation. What is crypto and why is it so important? So when we look at crypto, crypto was the best performing asset class last year, the year before that, and over the past decade. And a lot of times this doesn't come as a surprise to people. When we look at crypto, it's been everywhere lately. It's on TV commercials. Crypto companies' names are on the sides of football stadiums. It even comes up in casual dinner conversation. Crypto, by almost any measure, has become too big to ignore. Institutions are getting in, regulators are looking at the space, and advisors and financial professionals are getting asked questions about it. But while crypto is arguably one of the most exciting asset classes to have ever existed, it also can be one of the most confusing. And one of the most confusing things about crypto is that we call crypto assets like Bitcoin and Ethereum cryptocurrencies. And this is confusing because it makes people think that someone off in a corner somewhere created this idea of digital currency, digital money, and that it means that we should start going around in our day-to-day lives using Bitcoin in the same way that we use dollars. But that's absolutely not what crypto is about. Crypto is not about paying for your mocha pumpkin frappuccino at Starbucks. It's not about paying for your groceries. In fact, we here at Bitwise believe that it'll be a long time to never that we're using Bitcoin instead of dollars to do those things, at least here in the United States. But just because Bitcoin's not good for buying our coffee or buying our groceries, just because we're not using it in our daily lives, that doesn't mean that it's not useful. It just means that we have the wrong view of it. And while it may not be good for doing those things, what it ultimately is good for is for bringing money out of the analog age and into the internet era. And what I mean by that is that ultimately Bitcoin and blockchain present a technological breakthrough, one that gave us the ability for the first time to quickly, safely, and securely send and receive money over the internet, much in the same way that we can send text messages and emails today. And this is so important because if you think about it, money is one of the only things that we deal with on a daily basis that's stuck in the analog age. We can send text messages or emails or download any book from Amazon to our Kindles in a matter of minutes and sometimes even in a matter of seconds. But the minute that we want to go to our online bank account and pay our internet bill or our phone bill, it can take 3 to 5 days to settle. I have a friend who lives abroad. If I want to send her money, I have to account for the fact it'll take at least 2 days to get there. I can't send that money on weekends, and then I'll end up paying about 2 to 4% in fees. And this is crazy when you think about it, because we live in a world with technology ultimately at our fingertips with our phones and our iPads and our computers, and we can get almost anything we need instantaneously. So why does it still take money so long to be transmitted in a lot of these instances? If you look at the image here on the left, what this shows is a very simplified image of how money moves in our world. If I want to send money to a friend, one way I could go about that is by writing them a check. They would take that check to their bank, and then their bank and my bank would have to go through a series of verifications and validations before they could take that money out on the other side. Ultimately, the two banks would have to establish trust between one another. And it's a lot of times this process of establishing trust that can slow down the movement of money in our world. And that's why it can take even longer to send money abroad, because there are even more banks involved in that chain of establishing trust. And now I know what some of you are probably thinking, because I give this presentation multiple times a week. And a lot of you are probably thinking, Sophie, that's great, but you have heard of Venmo, right? And if this is what you're thinking, you're exactly right. We all love Venmo. We love Venmo as a society because it does give us the ability to send and receive money right away. That's why it's one of the most downloaded applications in the Apple Store today. But we're not just able to send and receive money faster in Venmo because Venmo is more tech forward or more advanced than your bank or my bank. Ultimately, the difference in speed of sending money from one bank account to another versus sending money from one Venmo user to another comes down to one thing, and that's database architecture. Now, to explain this, I'd like to first look at this image here on the left. So here we see a bunch of individual images, and we'll consider each of these individual images to be a different database. And if we think about a bank at its core, a bank is really just a database of accounts. We can say JP Morgan is just a database of all JP Morgan accounts. Bank of America is just a database of all Bank of America accounts, and so on and so forth. And so on the left here, we'll consider each of these individual images to be a different database. We can say this black one's JP Morgan, this pink one's Bank of America. You get the picture. And so if we go back to my prior example of wanting to send money to a friend by writing a check, if I send a friend that check, they would take that check to their bank, and then their bank's database would have to come to trust the accuracy of my account reflected on my bank's database. They'd want to make sure that that money's in my account, that I haven't promised it to anybody else, and that my account is in good order. And again, that's why it takes even longer to send money abroad, because there are even more banks or databases involved in that chain of communication. Now, if we look to the other side of the screen, to this single database here, we can talk about why it's faster to send money within Venmo. Now, if we look at Venmo's business, Venmo itself, you can consider as really just a single database of all Venmo's accounts. Venmo itself is a walled garden. If I want to send money to a friend in Venmo, Venmo simply needs to check my account, make sure the money's there, and then that money settles right away. But the minute that my friend wants to take that money out of Venmo into their bank account, it can take 1 to 3 days because we're leaving that single database perspective and going right back to the multiple database perspective. And so to summarize this slide, multiple databases equals slow, and a single database is fast. And if we look at the financial world, the financial ecosystem today, it consists of thousands of individual databases having to communicate with one another. Now, Venmo is actually one of the single best tools we have to explain Bitcoin and blockchain, because like Venmo, Bitcoin too is a single database. But where it differs from Venmo is that this single database can be viewed by anyone in the world at any time. Everybody believes it's accurate, and no single entity like a JP Morgan or a Venmo controls it. And once you have a decentralized database that can be viewed by everyone in the world, but that isn't controlled by anyone, you're able to do 3 things with property and money that we weren't able to do prior to its existence. The first breakthrough that occurs through the development of Bitcoin and blockchain is being able to move financial goods over the internet, or exponentially increasing settlement speed. Now, we talked earlier about how I have a friend who lives abroad. If I want to send her money, again, I have to account for the fact that that money won't travel on weekends, that it'll take 2 to 4 days to get there, and that I'll probably end up paying about 2 to 4% in fees. You can contrast that with if I wanted to send that same amount of money over the Bitcoin network, I could send it any day of the week at any hour, know it would get there in about 10 minutes, and that the whole transaction would cost about $3, regardless of the amount of money. Now, this is crazy if you think about it, because on the one hand, we have mega banks like Bank of America, for example, with offices in over 38 countries, a multi-trillion-dollar balance sheet, and over 200,000 employees. And the fastest they can get money from here to the UK is 2 days. And on the other hand, we have a grassroots network like the Bitcoin network with no employees, no physical location, and no controlling entity. And they can transmit that same amount of money in a matter of minutes at almost no cost. And not only does this concept of moving financial goods over the internet have huge implications for things like wire transfers, but also for things like stock settlement and bill payment. And it's this kind of 10x, 100x, 1000x disruption that gets us so excited about Bitcoin and blockchain. And now the second breakthrough that occurs is the development of programmable money. So we talked in the beginning about how Bitcoin brought money out of the analog age and onto the internet. And once money becomes native to the internet, there's no reason that it can't be programmed just like software. If you think about the financial industry today, a lot of the processes and functions that take place at their core are really just simple if-then statements. Things like trust agreements, escrow agreements, loans, and mortgages. I'm sure many of you have dealt with an escrow agent at one point or another, whether in the buying or selling of a house. If you look at the process of an escrow agreement, essentially the buyer sends the money, the seller sends the title, and the escrow agent simply crosses that transaction and usually gets paid thousands of dollars to do so. What that instead could look like in a world of programmable money is that we program if and when the buyer sends the money and the seller sends the title, that transaction will be automatically crossed, essentially removing the middleman, that intermediary, the escrow agent, and making it a much more timely, cost-effective process for all parties involved. And this idea of programmable money is essentially the foundation of the decentralized finance space that we're seeing growing incredibly rapidly today. And the third and final breakthrough that occurs is the creation of digital property rights. So prior to the development of Bitcoin and blockchain, if you wanted to record ownership of something, it had to be recorded in a third-party proprietary database. Banks keep track of account balances, county clerks keep track of land titles, and that list goes on and on. If you had something on the internet, whether it be a song, an image, a file, there was no way to guarantee that it couldn't be right-clicked, copied, and sent out an infinite number of times. But the development of Bitcoin and blockchain changed this, because once you have a database that can be viewed by everyone, but that isn't controlled by anyone, people are given digital property rights on the internet that never before existed. And now today, people can own digital goods like Bitcoin and NFTs and record that ownership, much in the same way that they could own a Picasso hanging on their wall, fine wine, or really any other rare collectible. And these breakthroughs are incredible, but what's also incredibly interesting about crypto is what I mentioned at the very beginning. Crypto has been the best performing asset class over the last 1, 3, 5, and 10-year periods. But with that strong performance has come a significant amount of volatility. I get asked a lot of times, what makes Bitcoin, what makes crypto any different from a tulip bubble? And this slide shows exactly what makes it different. With crypto, we've seen many significant drawdowns. Here we see drawdowns of over 80%, multiple drawdowns of over 50%, and many drawdowns of over 20 and 30%. But unlike a tulip bubble that would likely fizzle out after any one of these given drawdowns, never to rise again, what we've instead seen with Bitcoin is that after every significant drawdown, it's risen to new all-time highs, showing incredible resiliency thus far. Now, people look at Bitcoin, they look at crypto, and they think, how can this internet money have such strong performance and be so resilient despite its volatility? And the answer is that it isn't internet money. It isn't a currency. It's a technological breakthrough, one that's on par with other breakthroughs that have given us the ability to do things like send and receive text over the internet, send and receive images over the internet, send and receive video over the internet. And now today, through the development of Bitcoin and blockchain, to send and receive money over the internet. And so with that, we'll move on to our next section and talk about why more than one crypto asset exists. And so people look at different crypto assets like Bitcoin, Ethereum, Solana, and Cardano, and they want to compare them to different currencies like the dollar, the yen, the euro, and the pound. They look at the internet as this big phenomenon and they think, why would we need more than one internet currency? You don't have the need for different geographic currencies like you do on the internet. But if this is the way you're thinking about it today, I urge you to challenge that assumption. And instead of looking at different crypto assets in the same way that you would different currencies, to instead look at them in the same way that you would different software companies. And so here on the screen, we have Microsoft, Oracle, Slack, and Salesforce. If we think about the software company space today, ultimately different software companies are all built on the same core technology, but that technology can be optimized to do different things and to target different markets. Microsoft, for example, is great for creating documents, presentations like the one I'm sharing with you all today, and organizing data on Excel. Whereas a company like Salesforce provides companies with the ability to organize and segment their sales force, to do effective prospecting, etc. Both are important companies, both provide important services, but ultimately they have completely different use cases and target different markets. Much in the same way that different software companies can target different markets, crypto assets are the same way. Crypto assets too are ultimately all built on the same core technology. And like with software companies, that core technology, blockchain technology in this case, can be optimized to do different things and to target different markets. And to explain this, I'm going to walk through the two largest crypto assets that exist today. Bitcoin, as represented by this yellow symbol here on the left, and Ethereum, represented by this gray symbol here on the right. So if we look at Bitcoin, Bitcoin was the first crypto asset to come on the scene. It ultimately brought blockchain technology onto the internet. And now Bitcoin as a software is actually really very simple. with Bitcoin, you can do a few things. You can send Bitcoin, receive Bitcoin. You can do a few very simple functions, but ultimately from a software standpoint, Bitcoin is more akin to a programmable calculator than to a supercomputer. But Bitcoin allowed us to do something phenomenal, and that's that it gave us the ability for the first time to send and receive money over the internet quickly, safely, and securely, much in the same way we can send text messages and emails today. Now, Ethereum came along today, the second largest crypto asset, and saw that Bitcoin brought money onto the internet. And it thought, now that money's on the internet, why can't it be programmed just like software? And that's exactly what Ethereum seeks to do. Ethereum is what we call Turing complete, meaning that it can be programmed to do anything, to process loans, to process insurance, anything. And people hear this and they think, well, if Ethereum can do anything, then why is it the second largest crypto asset and not the largest crypto asset? And the reason for that ultimately is that Bitcoin is almost perfectly optimized for the store of value use case. We talked about how Bitcoin from a software standpoint is very simple. That means that ultimately, when we look at the amount of code that makes up the Bitcoin software, it's really just a few hundred lines. And from a cybersecurity standpoint, this arguably makes Bitcoin the most secure blockchain to exist. Fewer lines of code means less susceptibility to hacks, less stringent updates, and less susceptibility to bugs. Whereas on the other hand, Ethereum can do anything. But to be able to do so, Ethereum as a software consists of millions of lines of code, meaning that it's more susceptible to bugs, more susceptible to hacks, and has much more stringent updates. So ultimately, it's important to note that in order to have the capabilities that Ethereum has, it has to make the trade-off of security. And what you start to see as you go down the line of the top 10 crypto assets, as you look at the third, the fourth, and fifth, is that you start to see that these crypto assets are either directly competing with Bitcoin, Ethereum, or serving their own unique use case. And we imagine that much in the same way that today in the software company space, there are arguably 12, 15, even more institutionally important software companies with new startups coming into the space every day, that it will be the same story in the crypto asset space with maybe 10, 12, 15 institutionally important crypto assets and new startup crypto assets coming into the space, trying to do it better every day. And when we look at the different returns of different crypto assets, what you can see is that what we're already seeing is that different crypto assets are targeting different addressable markets and succeeding in finding market fits at different rates. And going back, looking at companies like AOL, Betamax, BlackBerry, MySpace, Napster, when we think back to 20 years ago, it would have been fair to make a bet that any one of these companies could be companies that we're still using in our daily lives today. And I show you this slide to say that it was very hard 20 years ago to predict which companies in the internet or the software space would be the Google and which would be the Yahoo. And it's the same story in the crypto asset space. Here at Bitwise, we're not trying to pick the winners. We provide strategies that provide access to the broad crypto ecosystem so that you can get diversified exposure to the space without running the risk of picking the wrong winner or betting on the wrong horse. And so lastly, we'll end today by walking through crypto in a portfolio. When we look at crypto from a portfolio construction standpoint, where we at Bitwise believe it best fits is in the alternative sleeve. Now, crypto has a set of unique characteristics that are usually hard to find in any one asset class. Crypto, while limited, has high historical returns. It's had historically low correlations to stocks and bonds. And unlike other alternatives like venture capital or private equity, it's liquid. Crypto trades 24/7, 365 days a year. You could buy it today, sell it tomorrow. The other thing about crypto is that it's open. You don't have the problem of access like you have a lot of times with other alternatives. In crypto, you can buy the same assets that Stanley Druckenmiller is buying, George Soros, and the Harvard Endowment. They're all investing in Bitcoin and Ethereum, and you and your clients can too. And when we look at the effect that crypto can have on a portfolio, what we see here is an addition of a 1%, a 2.5%, and a 5% allocation to a 60-40 portfolio. And what you can see here is that in every scenario, these allocations improved both the cumulative return of a 60-40 portfolio rebalanced quarterly and the annualized return. And if we look specifically at the 2.5% allocation, what we see is that the return was boosted from 74% to 112%. The Sharpe ratio was increased by about 40%, and that we barely saw the max drawdown or the volatility nudged up at all. And a lot of times this surprises people because crypto on its own is incredibly volatile. But because it's had historically low correlations to traditional asset classes, because you can rebalance it, in a portfolio setting, it can be incredibly impactful, and a very small allocation can go a long way. Now, what you do start to see when we look at the 5% allocation here is that return and Sharpe ratio are increased even more than the other two allocations. But we do start to see once we get over the 4% allocation threshold that there is more of an impact to volatility and drawdown. For that reason, Bitwise's recommendation is between a 1 to 4% allocation to crypto in portfolios. And lastly, what we see here is the rolling 3-year impact of a 2.5% allocation to a 60-40 portfolio. And what this ultimately shows is that there hasn't been a 3-year period in Bitcoin's history that adding crypto to a portfolio hasn't been beneficial. And so with that, we'll take some time and pause for any questions that the audience has.
Sophie, thanks so much for the presentation. Just as a reminder, and Kathy gave the shout out earlier, use the Q&A button at the bottom of your Zoom screen to ask any questions. And this is a new topic. I think the society, we typically fancy ourselves as well-informed, very educated going in to listen to our speakers. Nothing is out of bounds here. So please feel free to ask questions that can help you better understand with a great resource like Sophie today. So Sophie, I'm going to look at things. First question is, if the database or ledger is correct for all cryptos, how and why does theft occur?
Yeah, so a lot of times when we look at theft that occurs in the crypto space, a lot of times it's occurring on exchanges. So these are much more susceptible to theft. You have early on in crypto's days, the infamous Mt. Gox exchange that was hacked. So these aren't thefts that are taking place on the actual Bitcoin blockchain or on the actual Ethereum blockchain. But with new technology, I think it's important to note that it ultimately has to be battle tested. And what we've seen is that over time, especially over the last 5 years or so, that these exchanges have become much more secure and safe. But it is important ultimately to know some of the risks that occur with storing your crypto assets on different exchanges. And that's why it's really important to do your due diligence wherever you are transacting with crypto or storing your crypto assets.
Awesome. Another question, and I'm going to read this verbatim. So a little bit confused by one of the earlier slides talking about not using Bitcoin to pay for items, and then a slide talking about using Bitcoin to pay for items. Breakthrough number 1. Additionally, if we can transfer crypto quicker, but it still takes time to settle in wallets or bank accounts prior to paying in cash, doesn't crypto have to exist without cash to make this time saving worth it?
That's a great question. So you're exactly right. I did mention at the beginning that we at Bitwise believe it'll be a long time to never that we're using Bitcoin instead of dollars to purchase things in the United States. But what we're starting to see is that there are some very unique cases in which Bitcoin as a currency can make sense. I'm sure many of you are aware that El Salvador last year became the first country to make Bitcoin legal tender. When we look at them as a country, they're a very unique case. They have a high amount of remittances as part of their GDP. Over 70% of their citizens don't have access to traditional financial services, and they're a country that hasn't had their own legal tender. We also saw this year, the Ukraine became the second country to accept Bitcoin, and they also are actually accepting Ethereum as legal tender too. Again, very unique use case. In both these situations, 1, 2, even 5 years ago, it would have been hard to predict the path that Bitcoin took to becoming a currency in either of these cases. And despite Bitcoin's volatility, we are actually seeing it used in some transactions today, like remittances and micropayments. Going back to the slide I walked through on the first breakthrough, so exponentially increasing settlement speed. Ultimately, what we're talking about on that slide, and the point I was trying to make is that Bitcoin, the Bitcoin network, ultimately you can send and receive money much more quickly by not having to deal with intermediaries than we can in the traditional financial system today. That doesn't mean that you have to buy things with money. In the case of remittances, I think that's a great example of if we look at a country like El Salvador, if you perhaps had a family member living there and wanted to send them money, you can't Venmo them money. A lot of times, if you want to wire that money, again, it can cost 2 to 4%. It can take many days to get there. By being able to send that money via a crypto asset network, that money is able to get there much more quickly and much more securely. But you're ultimately not using that money to buy anything. It's more of a means of sending and receiving it. So there's no reason why cash and Bitcoin can't exist in the same world, because again, buying things like groceries or your coffee with Bitcoin doesn't make a lot of sense today. There's still a very important use case for cash in our society today.
Awesome. And then a couple of questions have come through the chat channel as well. How do you, or is there a fair value framework for thinking about valuations for Bitcoin or say Ethereum?
Yeah, so when we look at Bitcoin, for example, one of the best ways to value it today is to value it very similarly to the way that we value gold. So from a supply and demand standpoint, when we look at Bitcoin, the supply is ultimately known. There will only ever be 21 million Bitcoin in existence. And so since that supply is known, when you see people throwing around forecasts of Bitcoin's price, I know Kathy Wood said 500,000. I think JP Morgan said about 150,000. Ultimately, how they're getting to that number is that they're looking at the store of value market, looking at gold, offshore bank accounts, negative yielding bonds, arts and collectibles, and ultimately saying that if people store nearly as much amount of money in Bitcoin as a store of value as they're storing in these other store of value assets, that will be the price that Bitcoin could reach. So ultimately, they're looking at how that demand could fluctuate based on the amount of money stored in Bitcoin. When you look at other crypto assets like Ethereum, for example, you're able to view it in a little bit of a different way. With Ethereum, you're able to earn yield on your Ethereum. So you can look at it from more of a dividend yield lens. You see earnings, so you're able to look at it more similarly to how we would value stocks today. But that's what's important to know, is that these different crypto assets ultimately do different things. And as we mentioned, make trade-offs to do those different things. So for that reason, not each one is created equal. So there are different ways to value different ones.
Thanks so much. Questions keep coming, and I encourage everyone to keep using the Q&A or the chat. It's all okay. So the next question, how do you measure demand for Bitcoin? And they're referencing users, transactions, adoption. And how does this relate to the increase in supply of Bitcoin?
Yeah, so when you look at what drives the price of Bitcoin, ultimately it comes down to network effects and adoption rates. And ultimately that's what leads to the historically low correlations to stocks and bonds, is that the drivers of Bitcoin are very different from traditional stocks and bonds. When we look at demand, there are some very idiosyncratic things that could drive the demand of Bitcoin in the future. For example, there's been a lot of talk, and there are many, many applications, including our application here at Bitwise for a spot Bitcoin ETF. If that became approved, that would be something that would definitely drive the demand of Bitcoin as an asset. You have other things like what we've seen over the past several months with the Ukraine-Russia conflict. That really brought to the forefront again the potential need for a non-sovereign store of value. And so those are events that can also drive the demand for Bitcoin. So there are many different things, but those are some of the things. And then again, if we go back to the conversation on valuation, when people are making these price forecasts, they're looking at people storing a similar amount of value in Bitcoin as a store of value as they would in other store of values.
Awesome. And when we were chatting before the webinar started, we knew we were going to get one of these questions. What do you make of the recent drawdown? Any key drivers as it relates to Terra and Luna and general weakness lately?
Yeah, so what we've seen again over the past several months, I think it's been a hard time for many asset classes. Crypto is getting hit as well, crypto equities too. When we look at the crypto space, these crypto assets are risky assets. And a lot of times when you look at crypto assets, there are two factors that are driving the return. So on the one hand, as we mentioned, we have the more idiosyncratic factors, things like a Bitcoin ETF coming about, the need for a non-sovereign store value, et cetera. These are things that would drive the price of Bitcoin up and that wouldn't affect things like stocks and bonds. But on the other hand, because crypto assets are a very nascent asset class, because they are risky, we do see that when there is behavior and a move towards more risk off assets, that crypto assets and crypto equities behave similarly to growth stocks and innovation stocks in that event. And so that's what we've really seen these past several months, is that that risk on factor has really overwhelmed crypto as an asset. In terms of the Luna Terra event that occurred last week, what we saw ultimately, so when we look at the crypto asset space, we're starting to see really new sectors popping up. So stable coins could consider to be a sector of the crypto asset space. And what a stable coin is essentially is a crypto asset that's pegged to usually some asset, a lot of times a fiat currency, a stable asset. But when you look at the stable coin space, there are different kinds of stable coins. So you have collateralized stable coins like Tether, for example. And then what we have started to see is that algorithmic stable coins have come into the space. And so these would be considered to be more decentralized. In the case of Luna Terra, what we saw is that ultimately that algorithm was what was keeping it as a stable coin pegged to its peg. And as it became depegged, those algorithms didn't kick in the way that they were expected to. I think I mentioned earlier that these technologies are very new, and sometimes it takes being battle tested to see if the algorithms or things of this nature will hold up. And what we saw in the case of Luna Terra is that it didn't. I think this was something that a lot of people in the space were very skeptical of for some time. Bitwise, for example, has never included Luna Terra in our crypto index. For that reason, we do have a rules-based approach, and it was screened out due to some risks that we saw. Overall, for the crypto market, what does this mean? I think that what we'll see and what we've started to see is that there has been more of an eye on the crypto space in general from a regulation standpoint. We saw the executive order come out earlier this year. We at Bitwise thought that it was very balanced to positive for the crypto space and showed that the United States wants to better understand how it can protect its citizens as they utilize this technology, and then also how to best optimize this technology and be at the forefront of it. But I think that this shows that this is bringing more of an eye to the space. But ultimately, I think too, as these new technologies get battle tested, it also removes bad actors and more risky strategies too. And so ultimately, what we saw initially right after the event is that there was a flight to quality and flows going into Bitcoin and Ethereum over some of these altcoins. So overall, nothing's changed about the fundamentals of the top crypto assets. But I think as we see new crypto assets coming into the space, important to do your due diligence. Not all crypto assets, not all stable coins are created equally.
Awesome. And then bit of a pivot here to ESG. Are you concerned with some of the growing ESG concerns related to Bitcoin mining?
Yeah, so this question gets asked almost every meeting. It's a great question. So When we look at Bitcoin mining, I'm sure many of you have heard the statistic that Bitcoin mining consumes as much energy as many medium-sized countries. And this is true, but a lot of times this is a statistic that can be thrown around in a misleading way. So when we look at any really globally accepted industry or product, it arguably consumes as much, if not more, energy than Bitcoin mining. If we look at industries like aviation, shipping, construction, they consume double, if not triple, the amount of energy that Bitcoin mining consumes. And Bitcoin mining last year consumed just 10 terawatt hours more than holiday lights, to help put it in context. What we're starting to see, though, in the crypto space is that many Bitcoin miners are actually some of the cleanest and most energy efficient companies in the world. A lot of times they're using renewable energy sources. And because energy a lot of times is their top line cost, they're really incentivized to be as efficient as possible with their energy usage. And then we're also starting to see crypto assets like Ethereum, for example, shifting to more energy conscious approaches. They're looking to shift to the proof of stake mechanism, which will reduce their energy output by about 99%. And then we're seeing a lot of new crypto assets coming into the space day one with more energy efficient practices. So the overall outlook is positive. And again, compared to other industries, the energy usage is pretty minimal.
Awesome. During your presentation, you've used the term store value. And so one of the questions that's come in, why would, or I'm going to throw in, how could a store value asset also be a risky asset?
So that's a great question also. So when we look at Bitcoin, and it gets thrown around a lot that Bitcoin is a store of value, but it's important to note that Bitcoin is not a mature store of value. It's an emerging store of value. If we look at gold, for example, gold today is a store of value that's been used for decades and generations. It's held its value quite well over time. But if we look at gold back in the 1970s, when the US came off of the gold standard, it wasn't as stable as it is today. What we saw in the short term right after that was that it was normal to see swings in the price of gold of multiple percents in any given day. It had drawdowns of 50%, 30%. And that's because at that point, it was trying to find its way in the market as a store of value and wasn't quite a mature store of value yet. And so if you believe that a new store of value can emerge, what you would expect is that it would probably start with a very low price and be incredibly volatile, which is what we saw with Bitcoin. It started at around $1 and, believe it or not, was once more volatile than it is today. And if you believe that a new store of value again can emerge, you'd expect that over time, the price would increase and that volatility would decrease, which is also what we've seen with Bitcoin. The price has increased significantly and that volatility, while still very volatile, has come down. And so over time, as it continues to mature, we'd expect that one day it could be as boring, if not even more boring than gold. But again, important to note that we're still in the emerging store of value phase.
Awesome. So I've got a question actually. So I've heard people will say, I believe in blockchain, but I don't believe in Bitcoin, or I don't believe in crypto. Is that possible, or is that just an absolute contradiction?
Yeah. So when we hear a lot of times people say blockchain, not Bitcoin. And in a lot of people's minds, Bitcoin, blockchain, and crypto are all very synonymous with one another. Bitcoin's become essentially a mainstream catch-all for these three terms. But the reason for this is that Bitcoin really was the first crypto asset to bring blockchain technology onto the internet. But that's not to say that blockchain technology can't exist outside of Bitcoin. So when we look at different crypto assets, going back to when we talked about viewing different crypto assets like we would different software companies, every crypto assets, even crypto assets that do very different things from Bitcoin, are all built on this core blockchain technology. And it's also important to note that blockchain technology can be used in a decentralized way, like it's used with Bitcoin, and it can also be used in a centralized way by corporations, for supply chains, by banks, etc. So they definitely can exist outside of one another.
Awesome. There are a couple of questions on lending, different perspectives. So I'm going to read you two questions, and I suspect you'll be able to address both of them in one session. So first was, can you talk about lending crypto? It's my understanding you can earn high yields, but obviously with some high risks. How does that work? And then secondly, how has the market to borrow Bitcoin evolved over the last few weeks in the context of stablecoin depegging and the resulting market volatility?
Very timely question. So I'll keep reinforcing this, but when you look at the crypto asset space, important to do your due diligence on exchanges, different crypto assets, different stable coins, and also different lending platforms. So with Terra Luna, people prior to last week were getting, I believe, 20% yields on staking their asset. Essentially how lending works is you have a lot of these lending protocols where you can stake or put up your crypto asset and earn a set yield. And a lot of times they're much, much, much higher than what you can find in the traditional fixed income space today. But there's a lot of risk that comes with that. That being said, it's really important to do your due diligence on any platform that you're doing this and to fully understand the risks at play. Over the last couple of weeks, I think that in terms of what's changed is that people have perhaps become more aware of some of the risks at play and hopefully are being more stringent in their due diligence and not just chasing flashy yields like perhaps they were before, but definitely can find some yield, but important to be very knowledgeable of the different risks. Not all yield pools are created equal.
Awesome. Thanks, Sophie. And then another question within the chat: are you seeing material differences in Bitcoin to market correlation in market downturns versus more steady state market conditions?
So what we're seeing is that, like I mentioned earlier, over the past several months, because there is that risk on factor to crypto assets, is that they did behave very similarly to other risk on assets. We saw in 2020 the same thing. We saw in 2018 with the taper tantrum the same thing as well. Again, the history of these crypto assets is very limited, but what we've seen is, and I can get more data on this and send it to the group from my research team and provide some numbers and more color. But during times where the market has been more stable, again, we do see those lower correlations when that risk on factor is not in play. And more
Awesome.
The fundamental drivers of crypto are running the show.
Excellent. So, Sophie, thank you so much. In addition to, and I've already checked out the CFA Institute's website, does have the guide that Bitwise was responsible for. We're going to include that link in follow-up materials. What other areas can people do to do some digging? Any book recommendations or other areas where they can cover more thought leadership to increase knowledge in this area?
Yeah, definitely. So on our website, we house a lot of material. We have a white paper on portfolio construction, a white paper on crypto equities, which is a more indirect way to access the space, as well as information on our strategies if you're interested in learning more. The CFA Institute's guide is a fantastic place to start really building a foundation of your knowledge of the space. And in terms of some books that I've liked and have helped me learn more and more about the space, the Bitcoin Standard is great for learning more about Bitcoin. Into the Ether is a great one for learning more about Ethereum. And one about the crypto equity space, I like Kings of Crypto, which is about Coinbase, is one I actually just finished and really enjoyed.
Awesome. I was writing them all down. Sophie, thank you so much. I also want to thank all of our participants who connected with us today. As always, look out for an event survey. The best way that we can keep giving you and offering great programming like this today is relying on your feedback. Again, thanks so much. And this is going to conclude today's program. Have a great day, everybody.